Okay. A very good morning to all. In today's session, we are all going to learn what is national income, what are the various parameters or the concepts which relate to the national income, and what are the methods of national income or to measure the national income and with respective numericals. So let's begin the concept of national income. Basically, it refers the total value of all the goods of and services produced by residents of a country while working within or outside the domestic territory during the financial year. Basically, it is measured or expressed in monetary terms, and it also reflects the overall value of goods and services. And as I said in the definition, that it's a total value of all the final goods and services which are produced by residents of a country during a financial year. So definitely the national income is also expressed over the one financial year only. So let's begin. What are the various items which are not included in national income or in measuring the national income or excluded items in national income? So the first one is the sales and purchase of second hand of goods will not be included in measuring the national income. Whatever the income from illegal activities like smuggling, black marketing, and gambling, and many more illegal process will not be included in calculating the national income of an economy. It does not include any transfer payments. For example, any old age pension, any scholarship provided to the students will not include in such national income. What is the exactly the meaning of the transfer payment? Transfer payment are those earnings which have no contribution in estimating in or in the total value of goods and services produced by the residents within the domestic territory. That all that's actually called transfer payment, and which is not a part of measuring the national income. And automatically the transfer payments are not earned but received only, in whatever the receipt of whatever the payments is to be received will not included in national income. Even they are also received without doing or producing any commodity and service in the market or in the economy, and as a result, it's not a part of national income at all. So these are the following items which is not a part of national income, which cannot be considered in measuring the national income. So this is a figure where I distinguish between how to measure the national product and national income. So when we talk about the two major flow, that is the household flow and the firm's flow, basically it's a two-sector model when we calculating the national income and national product. So when we talk about the national product, household provide the four factors of productions to the firm, and firms use that four factors of production to produce the final output, that is goods and services to the household. And ultimately the household use that income which is being paid by the firms in the form of rent, wages, profit, and interest, which is a part of the income. And ultimately the household use that income to buy the goods and services which was produced or which is to be produced by the firms. So this is a cycle which is going on, and this is a way that how we consider in estimating the national income. It is the expenditure on goods and services, and of course the rent, wages, profit, and interest. These two particular factors which are equally you can see considered in measuring the national income. So these are the concepts of national income, that is GDP stands for gross domestic product, gross national product, net domestic product at market price, net domestic product at factor price, net national product at market price, net national product at factor cost. These are the following types of income: private income, personal disposable income, and national disposable income. So let's begin. You can see a little introduction about these concepts. Then we come up to the methods of measuring the national income, which is an important part of this particular unit. So let's talk about the various parameters or numerical or mathematical formula which will be used in measuring the national income. So the first one is when we talk about the gross and net, we always talk about the depreciation. But when we talk about the product at market price and factor cost, we talk about the net indirect taxes. But when we talk about the national product and the net product, we always talk about the net factor income from abroad. So when we talk about, you can say net to gross, we always add depreciation. When we go from gross to net, we deduct depreciation. In the similar way, when we go from domestic to national, automatically we add net factor income from abroad. So when we talk about, you can say the factor cost to market price, we always, you can see, add net indirect taxes. So how to calculate the net indirect taxes? That is the indirect taxes minus subsidies. So these are the basic formulas which is being used in all the methods of estimating national income. So when we talk about gross to net, we always talk about minus depreciation. But when we talk about net to gross, we always talk about plus depreciation. So when we talk about domestic product to national, we always talk about adding the net factor income from abroad. So when we talk about factor cost to market price, automatically we add net indirect taxes, and the basic formula of net indirect taxes is indirect taxes minus subsidies. So we talk about the basic concepts now, that is which is related to the national income. How to you can say symbolically to known to be it is a national income, that is NNPFC, that is the national income. We always talk about the national product. So if we talk about the gross domestic, we always talk about the gross value. So add it. So when we talk about GDP, GDP stands for that it's a total value of goods and services which is being produced within the domestic territory of a country during an accounting year. So how to calculate the GNP when we talk about the gross national product? So it's very simple. When we talk about gross national product, we always talk about domestic to net. When we go from domestic to net, so it means we add net factor income from abroad, because net product stands for adding the net factor income from abroad. So this is a basic conceptual framework. So what is the distinguish between the gross domestic product and gross national product? So when we talk about the gross domestic, it's a total value of all the final goods and services which is being produced within the domestic territory of a country by the residents. So when we talk about the gross national product, here it refers to the total money value of all the final goods and services by the normal residents of the country. So when the normal residents of the country, you can see they can add up the value to be, you can say, buy the goods and services, and that total value of all the final goods and services, that will be counted as gross national product. So when we talk about the gross domestic product, we always talk about it is a domestic concept, basically, which is mainly deals with the domestic territory of a country. But when we talk about the gross national product, so automatically from the term, it can easily understand that it is a national concept, because it is mainly deals with the normal residents of the country. and that's the main reason. So when we go from domestic to net, we always add the net factor income from abroad. Why we are talking about the net factor income from abroad? Because here we are talking about the national product. So if we subtract the net factor income from abroad, so definitely when we go back to calculate the gross domestic product, so automatically we consider GNP minus NFIA, that is net factor incomes, income from abroad. We deduct when we try to estimate the gross domestic product, which includes the gross national product, and deduct the NFIA. So when we talk about the GDP, we always talk about the you can say government and service sector. So automatically, when we go from you can say uh, net to domestic, so automatically we add net factor income from abroad. So it's very simple, which is a very similar mathematical formula which will be used from you can say gross domestic product and gross national product. So when we calculate the gross domestic product, we use the concept the net factor income from abroad. So whatever the value which we earned, and we add up the net factor income from abroad, we get the gross national product. Because if we adding up any net factor income from abroad, we get national product. That means a gross national product, because we are calculating the gross domestic product. So when we talk about the calculating the gross national product, so automatically when we talk about calculating the gross national product, we always talk about or consider the concept that is gross domestic product, and based on the gross domestic product and the net factor income from abroad, we get the gross national product. So if we talk about the, you can say the theoretical framework, the gross domestic product would be greater than the gross national product. That means the NFIA is negative, because in both the concept, we the most important factor that we include, that is the net factor income from abroad, whether to deduct or add. So that's the main reason to understand this particular the sign, that is negative and positive sign. If the GDP is more than the you can say gross national product, that means the net factor income from abroad, it automatically becomes negative. When the gross national product is more than the gross domestic product, that means the net factor income from abroad is positive or is become positive. So that is the distinguish between the gross domestic product and gross national product. So if the particular learner needs to calculate the gross national product, so definitely the first framework or the concept that he has to include, that is GDP. And we talking about the national products, automatically we have to add up the net factor income from abroad, and automatically we will get the GNP. Now we are talking about the net domestic product at market price and the net national product at market price. So obviously, if we're talking about the net domestic product at market price, so definitely it is a domestic product, because we are not talking about here the national product. And automatically when we talk about the net domestic product at market price, so we are talking about whatever the value of final goods and services produced, it's within the domestic territory in a particular year. So automatically when we talk about domestically word, the domestic word, there is no need to include the NFIA, because when we talk about NFIA, we always talk about the national product. So when we talk about that net national product, gross national product, then we talk about the NFIA, that is net factor income from abroad. So when we talk about whether it is a gross domestic or whether it would be the net domestic, we are not talking about the net factor income from abroad. So in the earlier slide also, when we talk about the gross domestic product, so automatically we not include NFIA. In fact, I always mention here to calculate the gross national product, we add national factor income from abroad. So net domestic product and market price, it is a domestic concept which NFIA has no role in it. In fact, when we talk about the net national product, so automatically it's a net national. It's the term which always denotes national product. So automatically it is a national concept. So we always include NFIA. Here we are considered whatever the total value of goods final goods and services by a normal residents of a country, whether the resident is belong within the country or outside the country. So it is a national concept which always include NFIA. But how to calculate the NDP MP and NNP MPs, the formulas are already given on the screen. When we talk about net domestic product at market price, automatically when we are talking about the market price, so automatically we have to consider the concept, that is the GDP NP. So when we talk about GDP MP and we're going gross to net, which is I have already shown the list of the formulas, when we go from gross to net, we have to deduct the depreciation. So this is a basic. These the mathematical formulas which has been shown earlier. These are the basic to understand it how or which concept to add on or deduct from the various you can say domestic products or national products. So when we talk about NDP MP, we need GDP MP, but we need some other element to deduct or add in the particular to estimate the NDP MP. So automatically when we need to calculate NDP MP, so we consider the concept that is GDP MP, and automatically we need to deduct depreciation because we are going from gross, we are estimating net. So if we go from gross to net, we have to deduct depreciation. And there is another formula to calculate NDP MP. So once you calculate NDP MP, there is another formula which is being used, that is the NNP MP, net national product MP minus NFIA, because why we are deducting minus NFIA, because here we are going back to net to domestic. If we are going from net to domestic, automatically we have to deduct NFIA. If we are going, if we are going from you can say domestic to net, automatically we have to add net factor income from abroad. If we are going to a reverse, net to domestic, we have to deduct NFIA. If we are going from you can say domestic to net, so automatically we have to add net factor income from abroad, which is already shown in the following formula. So there are the two formulas which has estimated how to calculate the NDP MP. So GDP MP minus depreciation and NNP MP minus NFIA. So why we have deduct NFIA? Because we are going back to reverse. We are going back from net to domestic. So we have to deduct net factor income from abroad. When we talk about the net national product and market price, so we are going to forward. That means domestic to net. Because here we are, when we calculating then NPMP, so we using the two concepts, that is GNPMP and NDPMP. So automatically when we are going forward from domestic to net, so automatically we will add net factor income from abroad. So when we talk about to calculating the national product and market price, automatically we have to add NFIA. When we are talking about in domestic, whether it would be the gross or domestic, considering whether it would be the net domestic, we have to deduct the NFIA. And of course, the depreciation, we are obviously going back to gross to net. The next concept is national domestic product at market price and the national domestic product at factor cost, which is also called the domestic income. So, what is the exact meaning of national domestic product? So, here we are talking about, here we are not exactly considering the resident of a particular country or within the domestic territory. No, here we are considering the both resident also and non-residents also. It refers to all that total value, a market value of all those goods and services which is being produced by both resident and non-resident within the domestic territory of a particular country in an accounting year. But this definition termed as national domestic product and market price, because here we are talking about NDP-MP. Now we talk about, when we talk about national domestic product, obviously the net indirect taxes will always be included. By because here in this particular concept, the resident and non-residents are both are included. So whether resident can do or non-resident, so taxes will always be included. That is the net indirect taxes. So when we talk about net indirect taxes, when we talking about taxes, so obviously we are talking about the market price and the factor cost. So when we talk about the net indirect taxes, so the formula is always been given that to calculate the national domestic product in market price, we have to add the net indirect taxes, which always be a part of you can say domestic national domestic product at market price. So when we talk about the you can say mine plus indirect taxes and minus subsidy, that means we have to add the net indirect taxes. Why we have to add the indirect taxes? Because we are going back to the factor cost to market price. If we are going back to market price to factor cost, then we have to you can say deduct the net indirect taxes. So when we talk about the national domestic product and market price, we have to add the net indirect taxes. When we talk about the domestic income or national domestic product, so automatically net indirect taxes are not included. That means we have to deduct the net indirect taxes if we are going to market price to factor cost. So this is the exact distinguish between the national domestic product at market price and national domestic product at factor cost. So this is the calculation of national income. So automatically to estimating the national income, the three main phases, successive phases in the circular flow, and that is the you can say production. So once the production the process would goes on, automatically the expenditure and ultimately the main you can say the income will be sourced from this. So from production it reached to income. When we earn, automatically we can expend something or we can expend our income on you can say producing the goods and services in a particular market. So this is a cyclical phase of the you can say national income, where we are talking about the three elements, that is production, income and expenditure. So automatically when we talk about production, the expenditure will also include in that, and of course earning. So automatically what the particular market earn, yeah, you can say in the you can sellers earn, so the residents earn, automatically they have to expend to buy more. These are the three main methods of national income. The first one is value added method or product method. Second one is income method, and the third one is expenditure method. So let's go on through one by one all of these methods. The first one is what are the steps involved in product method or value added method. So the steps, following steps to be followed to calculate the net national product and factor cost. So this is a procedure, step by step you have to follow, and you can easily calculate the net national product and factor cost, the ultimate the national income. So we need to identify. The first step is we need to identify the product units. So these are the main three sectors. The first one is primary, the second one is secondary, and the third one is tertiary. So when we talk about the primary sector, we always talk about the agriculture, forestry, fishing, and mining sectors. But when we talk about secondary, only the one sector would include, that is the manufacturing sector, and the territories belongs to the services, whether it be banking, insurance, telecommunication, net, you can say services, and that comes under third category. How to calculate the national product using the product method or value added method. So the how to calculate the GDP, that is gross domestic product, and market price. So this is a second step. So before you can say come to the second step, you need to follow up, you need to identify the product units in the particular numerical questions. So once you identify, so you can easily the question that this belongs to primary, this sector belongs to secondary, and this particular belong to third category. You include to the second step is to calculate the gross domestic product at market price, and you need to add all these particular you can say product units or sectors, and automatically you have to add, when we calculating the gross domestic product, you need to add the net indirect taxes plus depreciation. So when we talk about the deduction of depreciation, deduction of net indirect taxes, there is a particular trick that I have already told in the earlier slides. So when we talk about gross to net, automatically we have to deduct the depreciation. In other words, we call the consumption of fixed capital. So when we talk about the market, when we reach up to the you can see market price to fixed cost, we have to deduct the net indirect taxes. When we are talking about the market price and fixed cost, we are talking about the net indirect taxes. When we talk about gross to net or net to gross, we are talking about depreciation. But when we talk about domestic to national, we are talking about the net factor income from abroad. So this is a key points to identify and to memorize the formulas. So when we talk about gross to net or net to gross, we talk about depreciation. But when we talk about factor cost to market price, because here we are dealing with residents and non-residents of the country within a domestic territory and in a particular year. So we are talking about the net indirect taxes. So if we are dealing with domestic to national or national to domestic, we are using the concept that is net factor income from abroad. So it's very simple to understand the formula. So if we already, the second step is you need to calculate the gross domestic products. When we talk about gross domestic product, we are talking about using the product method, the three main units we have to add, whatever the amount has been mentioned in the question, then everything to be added, that is the depreciation and in net indirect taxes, because here we are calculating only the gross domestic product and market price using the product units or the units of the product related to the various sectors, and added every parameter, that is in net indirect taxes and depreciation, because here we are dealing with the various sectors. But once you calculate the gross domestic product and market price, you need to calculate the third step, that is NDP-MP. So when we talk about net domestic product and market price, we consider the concept of gross domestic product and market price. So when we go back to gross, when we go to gross to net, we have to deduct depreciation or consumption of fixed capital, that is the same. So once you calculate the NDP-MP, the third step is you need to calculate the NDP-FC. So obviously, when you need to calculate the NDP-FC, you require the calculation of NDP-MP. So once you calculated NDP-MP, involve that NDP-MP to calculate the NDP-FC, and once using the concept of NDP-MP to calculate NDP-FC, so automatically, if master factor, factor cost and market price, we have to deduct. So once you go back to market price to factor cost, you need to deduct the net indirect taxes. So once you go to domestic to national, we automatically add the net factor income from abroad. So this is the procedure, the steps that you need to follow. If you follow one by one steps, automatically your answer, your numerical question and with respective answer, they will definitely correct. So now, before that, we have talking about the product method. The second method is income methods. So whatever the steps that we need to follow, the first two steps, before I come up to the most steps, the two main steps is identify the producing units. Whether it's belong to primary, it's belong to secondary, it's belong to tertiary. Once to identify, the second one is classifying the factor incomes. Then whatever the income that earned from the various factors in the sense of whether it would be compensation of employees, operating surplus, or any mixed income of the self-employed person or individual. So this is called the factor income. So you need to classify. How you classify the factor income? Compensation of employees, you need to classify the various items which comes under the compensation of employees. You need to find out the various items which comes under the operating surplus, and whatever the various items which comes under the mixed income. So once you add these three items, the three income, it becomes factor income. So now in the compensation of employees, we are talking about the remunerations, the income that we provided or given to the employees in the form of wages and salary in cash, compensation, private pension. So when we talk about the operating surplus, we are talking about whatever the sources, the income that the particular individual earn. The first one is income from property. It would be rent, it would be interest, it would be loyalty. That is comes under operating surplus. Any income earned from entrepreneurship, that would be in the form of profits, revenues. So that is a part of the operating surplus. When we talk about the any mixed income, we are talking about the professional services. We are talking about the professions of doctors, lawyers, accountants, teachers, that is a mixed income of the self-employed. So when you end up, you will get a factor income and using the income method. So when we talk, students might confuse, oh, what would be the factor income to be calculated using which method? Automatically, if we are calculating any income of various factors, which is mainly for the three main factors, we use, that means it is a income method. Now we have to follow up step by step, you can say, to calculate the net national product and factor cost. So ultimately, any method we will use to need to calculate the net national product and factor cost. So once you calculate the factor incomes, all will be added, right? All will be added, whatever the operating surplus or any amount would be operating surplus, mixed income of self-employed. So once you get the, you can say, and whatever the factor income to be from all these the three sectors are added, so that will be added in NDBFC. So before calculating the NDBFC, automatically you need a GDBFC for that. So before calculating the GDBFC, you need GDPMP. So how to calculate a gross domestic product at market price, that is the compensation of employees, whatever the items which are included, that is rent, income, mixed income, and operating surplus added, that is net indirect taxes plus depreciation, which is a part of the gross domestic product at market price. So when we go up to calculate the gross domestic product at factor cost, you need GDP, that is gross domestic product at market price. So when you go up to from market price and factor cost, or to go back to market price to factor cost, we need to deduct the net indirect taxes. So once you estimate the gross domestic product at factor cost, the next step is to calculate the net domestic product at factor cost. So once you for calculating the net domestic product at factor cost, you need gross domestic product at factor cost. So once you get the gross domestic product at factor cost, so automatically you need to deduct my depreciation only, because it's going from gross to net. So depreciation will be included and that will be deducted to calculate the net domestic product at factor cost. Once you calculate the national income, you need to add on net factor income from abroad to get the net national product at factor cost. So that's it. That it's for today. I come up with the more relevant, you can see, numerical questions in the next session. So thank you so much for listening, and namaste.